Hey everyone, Meet Kevin here. I am so excited to have Harry Dent on the Meet Kevin show. Harry Dent is a New York Times best-selling author with titles like What to Do When Bubbles Pop, 0 Hour, The Great Depression Ahead, and Harry Dent now also has a free weekly newsletter at harrydent.com. Harry Dent touches on the market, he touches on Bitcoin, and I'm super excited to have him on here. I feel honored. I want to hear all the perspective I can get. Harry, welcome aboard. Tell us what's happening. What's going on?
Well, Kevin, I got interested in you because you were talking about bubbles, and people don't like to talk about bubbles. Bubbles make people high. Just like this is a financial drug we've been getting quantitative easing since late 2008. It makes everybody high. Everybody's got 3% mortgage instead of 6, 2% car loan instead of 7. Their stocks are going up crazy. Their real estate's going up crazy. And of course, that affects more people, the real estate. We're in the second major real estate bubble. And we're in the second big tech bubble and stock bubble, and all of this is getting ready to burst. And I tell Kevin, like the .coms in the last tech bubble, the real finale was the .coms only came in the last few years to the other tech stocks, and Cisco and Comcast and all those leading, and Apple and everything. They came at the end and they were the biggest bubble, and then they crashed the most. The NASDAQ crashed 78%. The .coms, the internet index, crashed 95%. Amazon, the leader, went to 136 and back down to $6. That would have been the buy of the century, buying Amazon there. I see that the Bitcoin and blockchain is the same thing. It is the second stage of the internet for financial assets and money, which is really, really important with $520 trillion in financial assets. That's the biggest number in the world right now, other than derivatives, which is puffy. And so this is a big deal, but my analysis shows how new industries emerge. The .coms bubbled up to crazy valuations. Try 450 times earnings on AOL. Okay.
Wow.
And other companies with no sales and no earnings getting billion-dollar valuations. This is what's happening now. Bitcoin is not worth 42,000, and it may go to 100, but it is going to crash in the next year or two with tech stocks and this bubble. And the question is, and I heard some of your thing. I think stocks are going or likely to start to crash sooner than later, just because this bubble's getting out of hand. People don't understand what the Federal Reserve and central banks around the world did when the 2008 recession started to turn into a depression in late 2008, with Lehman Brothers going, everything started to look like 1930. And that's what I was forecasting would happen, by the way. We were in that season with the baby boomers stopping spending and so much debt. What they did was they found out by accident, they pumped a bunch of money into the system by buying financial assets, and it didn't get people to borrow more because they were already over in debt in the bubble, businesses, consumers. What it did do was raise financial assets and at least make the top 10% feel wealthier, and they spend 40-50% of the money, by the way. And we've been on QE ever since, and they keep doubling down. What they don't realize is, to avert a debt bubble, back then there's about 180 trillion in debt. Now there's 250, but financial assets have raised way beyond that. There's 520 trillion in financial assets, because QE is unique. It goes directly into financial assets, which means more money chasing the same. It also sends clear signals to the traders. Oh, the Fed's going to keep stocks up, going to keep interest rates going down long term. So they make more leverage bets. So the Fed adds, 7 trillion to the markets alone. And now all these traders leverage up at almost no cost, at zero interest rates, and add leverage to that. And that's how financial assets are now the biggest bubble ever. And if I was the Fed, I wouldn't be worried about the debt bubble. That takes a while to go through Chapter 11 and Chapter 7. Financial asset bubbles can burst overnight, like 29 to 32. And we saw last year, just in 5 weeks from February to March, globally, stocks crashed 40%. In the U.S., it was 35% on the S&P, 44% on the Russell 2000. Bubbles can burst much faster. And you have to understand, this is all wealth. Debt is wealth, financial assets is wealth, cash and stuff is too, but a couple $100 trillion is going to disappear, I think, the next couple of years. And I think that's what burst the bubble. I know you have a feeling, that they, they can pull some more tricks and stuff. And normally a downturn is triggered when the Fed raises rates and inflation is going. We are getting some mild rises in inflation, but I still don't think you're going to get much. We are in a deflationary era, Kevin. I've given all my speeches. I literally come out and say it's impossible to create even normally high inflation in this high debt, high bubble environment, because it all wants to deleverage and deflate. It's impossible to create the hyperinflation that the gold bugs are looking at. This will end in deflation. It will end in high unemployment, high business failure. Most of all, I'm estimating 200 to 250, 40 to 50% of that 520 disappears. That hurts. You don't get a recession when that happens. You get a depression like 29 to 32. Most recessions do not see big financial asset bubbles and debt deleveraging. Only in the 30s and only now.
No, I mean, there's a lot to unpackage here. I mean,
Yeah.
so, geez, I mean, first of all, I mean, what should people do? I mean, what's your opinion? Because, for example, somebody like me, tech stocks, my biggest holdings, all right? Tesla, Apple, Amazon, some of my favorites, right? The Etsy's of the world. I've got a little bit of Bitcoin too. It's kind of like you're going down the list. I think the only thing you haven't beat me up on yet was real estate, but ouch, man. What is somebody supposed to do?
Well, first of all, bubbles are bubbles. The bigger the bubble, the bigger the burst. Am I worried about real estate in Omaha down the street from Warren Buffett? No, not really. Everyday house probably went from 100 to 170, 180. Yeah, that may go down 20%. High-end real estate and real estate, commercial goes down the most, then high-end real estate, because the rich people have the most money in a bubble and bid up real estate with it. And tech stocks go down more and those, high growth stocks than ordinary stocks, and obviously defensive stocks and utilities. But ultimately, the biggest bubble right now is Bitcoin and blockchain.
Wow.
Bitcoin is the next big thing. It could be the standard for a whole bottoms up monetary system that I can envision today out of transactions. I think central banks are going to be the victims of this next downturn. They have blown up this bubble they call it an experiment. This is stupidity. This is something for nothing, okay? Something for nothing never cures anything. You don't just print money and then a recession or depression goes away. You have to deleverage debt. You have to deleverage bubbles. You have to cut spending. You have to do all these things. That's what we did in the early 30s. It was the worst crash in history. But unlike 2009 forward, where we come out at 1.5 to 1.6% growth, we came flying out of there because we deleveraged and made the system more efficient. So the central banks have a massive, Kevin, misunderstanding of economic dynamics. We need booms and busts. Booms, we expand. Busts, we retrench and get rid of the bad stuff. We need inflation. Inflation encourages high payoff investments, and deflation encourages radical new investments and innovation in the future. The economy needs booms and busts, inflation and deflation. You know what the Fed wants? An economy that runs like a machine, 3% growth, 2% inflation, no recessions ever, which means they understand absolutely nothing about how the economy actually works. And you know why? Academics who never had sex or run a business. That's my description. Think of the Fed chairman, Yellen, Bernanke. Am I
Gotcha.
wrong?
So
do they look like they've ever run a business?
I gotta know. I mean, you it sounds like you almost align a little bit. Maybe with look, Ray Dalio's talking about a great deleveraging happening. Bill Gurley was on Bloomberg yesterday talking about how really what the Fed has been doing is they solve a crisis by creating a bubble, by printing money, and then their solution to the next crisis is printing more money and inflating that bubble. And they're just going to keep doing this
by doing more of the same thing that got it. You know what cures
what stops it?
Including income inequality. Let the bubble burst. Let the bad loans fail. Let the zombie companies, now 20% of companies, public, not small businesses, it's worse for them, cannot pay their debt service. Public companies, okay? Let the bad companies fail. Get rid of bad debt. Put capital back in growth areas. Yes, people will be unemployed and they have to be reemployed by growth companies again. You cannot get to the next boom without resetting the excesses of the last one. And we've been fighting that since 2008. And it's the worst possible policy, which means this downturn can only be worse now that we've put it off for 10, 12 years.
So, but what's the catalyst? I mean, hey, I'm kind of liking what's going on with stocks lately.
Oh
I
yeah.
like that my real estate's up. What's the what's gonna make it happen? Is it blockchain? You're thinking?
No. Well, yeah. It's the extremes. If blockchain goes, I mean, I literally have a projection on an
Okay.
exponential chart now that it's broken the linear trend.
Mhm.
At 35,000 recently, that it could go to 160,000 near term, or if it makes
Oh,
it on its
the
4-year
Dow.
cycle to 300,000. Extremes, yes. Now, but here's the thing: what since the Feds will not raise interest rates, they've already pledged never, ever, ever to have more than zero interest rate. 2023. That's never, ever at this
Mm,
point. What will
right.
do it? The smart money, when they decide, and they have a lot of leverage and a lot of fun. All the major hedge funds, people like Ray Dalio, decide this is over, and they start shorting the market with heavy leverage. That's when it happens. I think that's getting close
Ah.
because there's too many ridiculous things. You know, uh, Airbnb and DoorDash come out immediately doubles. That was happening in February, right before the last tech crash. This GameStop thing, 482 and 112 in the same day. That only happens on markets on crack where there's so much money swishing around, so much leverage at zero interest that the hedge funds can play this crazy game. And now the everyday traders can play it. And thank God they kicked the hedge funds. They deserve it. What they showed, what they did to the hedge funds is exactly what hedge funds do to everyday investors every day. They see
Well,
people getting one position long and then they just kill them. They jump on it with high leverage. I think high leverage, what I call predatory trading,
mm,
should not exist. Leverage should be used to hedge risk, especially for commercial businesses, not for predatory trading. And I think this thing with GameStop brought up a good issue, but just the fact that GameStop did that, that's a sign of a top. I think the smart money, it will take the smart money, and I can't predict when that's going to happen.
mm.
I have a turn point mid to late February, in March, potentially very similar to the one last year and to the last tech top. And Kevin, I'm cycle man. I got a 90-year super bubble cycle hitting here. There's a reason this cycle got extended, even though the baby boomers would have normally caused a downturn deeper in 2008. The bubble cycle hits here, 2019 to 20. Okay. And we got a 40-year. This is the most solid. Look at the major bottoms in stocks: 42, 82, and now 2022. That's the bottom of each generation spending cycle, which I can measure and project. I predicted we would go into a slowdown in 2008 after 2007, 20 some years before it, with simple demographic projections. So, all these big cycles are hitting,
Mm.
and then some small cycles. I think this is coming sooner than later. And I don't, it's not going to come. The Fed is not going to stop this. The Fed has to double down and double down. That's what they keep doing. They just printed as much in 8 months since the repo crisis and the COVID crisis as they did in the entire QE cycle for 80 months before it. This
Jeez.
is much. So they're having to print exponential. So what else? I think the next crash will be deeper. Another thing to notice, Kevin, and this is just
Mhm.
pure fact.
Yeah.
Since the January 2018 top, that was the 2017 was the best year in the stock market until just recently. Okay. That was a real bubble like top. Ever since then, we made lower lows, then higher highs, and lower lows every time. We just made a higher high. Next lower low, get this, 2,100 on the S&P 500. This is a very precise calculation, by the way.
Mm.
45% for the S&P down from here, 50%, more than 50% for the tech stocks. I think that sort of crash after the central banks, and it wasn't just the Fed, globally, and this time fiscal stimulus, and this time they actually gave money to businesses and consumers instead of just pumping up financial assets, which is way worse.
Right.
I think when people see this, we go into another deeper crash and another downturn after they just printed $4 trillion in money and $4 trillion in fiscal stimulus, now going on 5 or 6 with the Biden plan. I mean, the people are going to say this doesn't work. Even people high finally realize they're drunk and go into rehab, and that's what this is
So
going to be, a big detox, deleveraging,
So
detox.
it's interesting because a lot of people are talking about high inflation coming. You're actually talking about a deflationary deleveraging that is going to be led by the smart money, is going to destroy the average everyday investor. But what if you're wrong?
Well, okay. What I do, the reason I don't tend to be wrong on major events is I look at history.
Mhm.
I don't have
Okay.
Peter Schiff. I debate him and Jim Riggin. They have ideology. They just love inflation because they love gold, and gold loves inflation. So they always come out with a scenario where
Gotcha.
gold wins in a crisis. Gold
Uh-huh.
won only in an inflationary crisis in the 70s. You look in history, 9 out of 10 major financial asset and debt bubbles end in deflation because you deleverage the money you create in the bubble. Debt creates excess money in the economy, more spending than you would have, more liabilities, and it causes financial assets to go up. And then when you do QE, the financial assets trump everything. We've got the worst of
Right.
all worlds here. That money disappears. The government debt will always, people say, well, but governments will spend more in a downturn. They will. Government debt's only about a quarter of the total debt, okay?
Mm.
Private debt in the early 30s crashed, deleveraged by about 50%. It disappeared and never came back, got wrote off, restructured. Chapter 7, Chapter 11. That is healthy. It takes debt off of consumers and off businesses and frees up the healthy ones that survive to grow again and to take over the losers at 10, 20 cents on the dollar. It forces the winners to get stronger and the losers to get out of the way. In bubbles, in booms, everybody does well. That's great for innovation and adoption, but you have to have the downturns to shake it out to the winners. That's how free market works. George Gilder is my favorite economist. He's like me. He's not like a normal economist, out of Yale and stuff, economist land.
Mm.
He says the secret of free market capitalism is failure. Failure is as important or more than success. If you don't have failure, it doesn't work. The central banks are a bunch of ninnies who think, oh, we can't have a recession. We can't have some companies go under. We can't have unemployment. Oh, my God. They're a bunch of ninnies. They know nothing.
So you're actually saying that, rather than this Fed mantra of let's soften the highs, let's dampen the lows and kind of help the lows up so that we have this flat market. You're saying that's almost anti-capitalistic, that we have to have failure. But what's going to cause this? Where are the needles? What are the needles that we got to watch out for? What can I track?
This bubble burst and everything gets reset back to normal, painfully but rapid, like 29, 30. I'll give you another example. Why you don't want the flattening. You know what the difference between Homer Simpson and the top 1% that control 50% of the wealth? They take more risks. They have more ups and downs. They have higher risk tolerance. Elon Musk said it a few months ago. He said only 1% of people will come back after a huge failure. Entrepreneurs, I've come back 7 times in my career, okay? Every entrepreneur I know does that. That's what the 1% is. That means basically the free market system works better when there's more volatility, more booms, more busts, more inflation, more deflation. Deflation means rapid deleveraging, and deleveraging in the Depression, we had radical innovations like the computer and jet engines and radar and stuff. This is radical stuff long term. In the inflationary revolution of the 70s, we had personal computers, cell phones, much more incremental. Those pay off sooner, okay? But you need deflation and inflation, and you need booms and busts in an economy to work. Now, the way to not have more extremes than necessary is don't let a bubble go wild. Well, they pumped up the bubble way more. This bubble should have burst in 2007-8. We should have, if the recession had just gone 34 months in the stock market decline instead of 17, like 29 to 30, if it had just gone on another year and a half, we would have deleveraged all these debt. The financial bubbles would have deleveraged, and we would have grown stronger, and we would be coming into a milder downturn at the end of the baby boom cycle here. That's what happened in 29 to 42. They had the big crash at first, and that was the 90-year cycle back then, by the way. These generation are 40. So what we're having this time is we had the little crash first, 2008, because the feds bailed us out, and we're going to have the big crash at the end. The only good news I have for people, and I'm telling you right now, you watch this, Kevin, if I'm right, and in the next 2 years, we have a much bigger downturn, and the central banks can't stop it, and they fail and lose all credibility, economists are going to be saying, woe is me. Now we're in for a 10 to 14 year long lost decade in depression. No, this is going to be the end of it. And the millennials are going to pull us out of this, just like the baby boomers pulled us out of the early 80s deep recession. So I'm saying this is it. This is just going to be 2 to 3 years, 2 years for the markets, 3 years for the economy. And then we go into another global boom. It just won't be as strong as the last one because the demographics aren't as strong.
So what specifically as an investor do I watch for? Do I care about looking for inflation declining then? Am I looking, am I looking at politics? Do I talk about what Biden does, or what do you look
No,
for?
I don't even
Yeah.
care about politics. When the
Mhm.
deleveraging happens, here's the thing, and this only happens in these
Mhm.
big bubble cycles, okay? Like 29 and 32. All financial assets go down. In the 70s, bonds went down, stocks went down. Neither of them like inflation, but Japan went up, commodities went up, gold went up. So a balanced portfolio, if might have done okay. It would have been a difficult decade. In this type of downturn, everything goes down except, Kevin, the
Yeah.
safest high quality bonds. You know what the safest high quality bond in the world is today? In most
Treasury.
gold, do not, the 30-year Treasury. 30-year, even though it's at 1.2, almost 2% today recently,
Mhm.
people say, well, 2%, and how much lower can it go? No, it just in the last crash, it went down to 0.7. I think it's going to go to 0.5% to 0. That's going to cause that bond, because it locks in the rate so long, to appreciate 40 to 50% when everything else is falling. Stocks, real estate, commodities, and gold. Gold will go up in the early stages thinking, oh, money printing and more inflation. When they see deflation, like they saw Lehman Brothers, gold suddenly went down 30.
Mhm.
It's first dropped 33% in 2 months when it saw deflation instead of inflation. You do not, I'll tell people right now, I'll stake my life on this. You do not get inflation out of this sort of deleveraging. It's impossible. It's impossible. If money printing would have caused inflation, well, how come 23 trillion collectively, the
Mhm.
most money printing ever in history, the highest percentage of GDP, and now fiscal stimulus has not caused any inflation? We can't even get up to 2%, Kevin, with all the money.
Wow.
It shows you that the money printing is stopping deflation. It's countering deflation. Why? Ben Bernanke understood better than anybody. Me being an academic, but he did study the Great Depression. That was his thesis, okay? He realizes that deleveraging, deflation causes the worst downturns, unemployment, business failures, etc. And his goal, as any economist, spare pain at all points. The truth is, pain is good for the economy. If people don't go through pain, the people who go, I start my speeches now. Where did you learn the most? When you got your ass kissed or your ass kicked? Okay. That's very obvious to me.
Nice. That's a
Get
good one. I like
complacent when
that.
things go good. If we don't
Yeah.
have a good recession and once in a lifetime a good depression, we do not grow. So this is
Wow.
this is the depression we have to have, Kevin. It's a horrible thing to say, but I'm telling you,
Yeah.
if this happens 3 years from now, we'll look around. Oh my gosh, income inequality is not so bad. Oh my gosh, millennials can afford to buy a home. Oh my God, people can invest again and expect to make 7-8% a year on the stock market again. Because if you buy stocks at these valuations, models that have nothing to do with downturns say just at these valuations you will lose 2 to 3% a year for the next 12 years.
Wow. Wow. So you're probably not too excited about index fund investing or how about even
No.
SPACs and things like
No,
that?
everything goes down. Now, if
Wow.
you don't trust me and say, well, maybe, but okay, well, just be more defensive. You're being stocks, be in defensive stocks, be in utilities, consumer staples. They'll just go down 50% instead of the tech stocks 90. That is what you expect tech stocks to go down to, by the way. My long-standing, I've had this target for 20 years, and I've had the target for late 2022 on my 40-year and baby boom cycle, that the Dow would be at 5,000 at the end of 2022. That's 2 years from now, and that is about an 85% decline. That's the Dow. So tech stocks going to be more. I think tech stocks could be down 90 to 95%, and the blockchain for sure. Bitcoin could go to 100, or it could have already peaked, but I think it ends back up at 3 to 4. And then I would load the truck up with Bitcoin, Ethereum, whatever survived, because it would have been like buying Amazon at $6 when it hit 35, 50, 18 years later. If you'd have bought
So
that.
that's interesting. It sounds like what you're saying is, and maybe reading a little bit between the lines and connecting some dots here. It sounds like what you're saying is the market and everybody thinks that this great inflation is coming, and as a result they're hedging with maybe Bitcoin, and that's actually creating Bitcoin to skyrocket. But what's actually going to happen is we're going to see a great deleveraging, which is going to lead to a deflationary spiral. 2 to 3 years of pain. That's actually the time to buy Bitcoin.
Right. Now, two big mistakes there with Bitcoin. Number one, Bitcoin is not an inflation hedge, never designed to be an inflation hedge. It is like the bubble, okay? Just like the .coms. And so is Ethereum and all the blockchain companies. So it's not a safe haven. It's a bubble, which means it'll burst, and it'll burst more than anything else because it bubbled up more. It's not an inflation hedge. Gold is an inflation hedge. Now, if we did have an inflationary outcome, gold would do well. I'm saying like 2008. This will be like 2008, only deeper. That when gold realizes this is deflationary, it will go down. It may go up a little more first. I actually have a higher target on gold, 2,200, although it may not make that because Bitcoin is stealing gold's thunder. These institutional people moving into Bitcoin know less about it than anybody. They're seeing it. They are. Paul Tudor Jones at a conference I was at saying he's buying Bitcoin as an inflation hedge. If I want an inflation hedge, I'd be buying gold, and you're still going to lose on that. But you do better buying gold than Bitcoin. It's a total misunderstanding of Bitcoin. This is an early stage industry that is wildly overvalued in the midst of the internet bubble, and it will eventually be the next big thing. And I could see Bitcoin going to 500,000 a coin down the road, maybe 1 million. But down the road, I see 3,000 to 6,000 first.
So when you have funds like Kathy Wood's ARK investing into the Grayscale Bitcoin Trust to get this Bitcoin exposure. Oh, that's right. You let me know when you're good.
I lost it.
I can hear you. I see you're good. You can hear me? You can't hear me. That's all right. You want to maybe try rejoining? I'll send you a quick message here. Let's see here. 1 second here. Let's see. Want to rejoin. Okay. So we will see if you can rejoin here. I'll go ahead and so Harry's going to rejoin really quick. So very interesting. I'm very interested to ask some more questions here as soon as Harry is able to rejoin. Really, there's so many people talking about in basically Bitcoin. Bitcoin being an inflation hedge. Harry's got a completely different point of view on that. That no, this isn't this is not a hedge. This is a bubble. But in the future, Bitcoin could actually mature. That's going to be a very interesting thing that I want to talk to him about because if we go into a deflationary cycle, why bother with Bitcoin? Why not load up on Tesla if it's down at $90? Kind of like the Amazon $6 days. And I'll look at to see what kind of questions you have as well. I know there's some questions about real estate as well, so we'll definitely ask those as Harry comes back. Here we go. Here, let's see.
I hear you now. I got back in.
Oh, perfect. Welcome back. So yeah, I was just mentioning to the audience here that why. So what's confusing me a little bit is you're saying that Bitcoin is immature and it's a bubble and it's going to burst, but tech's going to go down 95% along with this bubble explosion of Bitcoin. Why, if people are investing in Bitcoin for the wrong reasons, why don't I just buy Tesla at, $90 if it sells off 90%? Why would I go into Bitcoin in the future?
Well, okay, because Bitcoin is probably even more powerful. It's been a more powerful, both of those. Tesla is kind of like an Amazon, like the leading bubble. If Tesla continues to do what they do in the next boom and leads the electric car market, which is still a question mark, by the way. I mean, they got a great brand, but they don't have scale. And scale matters in cars. So I have a question mark. But if they do, they will be a great stock. And I think Tesla's going to at least 40. So if you can get Tesla at 40 or Bitcoin at 3,000, I would buy both of them. Because I don't want to put my eggs in. I would buy some Ethereum. I'd buy some Bitcoin. I'd buy Tesla. I'd buy the NASDAQ 100. I would buy, you have to say how much risk you want if you're in stocks. If we have the crash I'm looking at, I would have half of my stock portfolio at a minimum in the tech stocks, which includes to me, Bitcoin, blockchain are the tech sector. That's the right understanding of what they are. They are the next internet S-curve. And it's a big deal. Because let me give you a definition, simple. that blockchain is the digitization of all money and financial assets. And financial assets is the biggest number in the world. Let me give you a rundown. 520 trillion in financial assets, 250 in debt. Now, this is at a bubble peak, but 91 trillion in M2, 37 trillion in M1, and 84 trillion in GDP. What's the most important number there? $520 trillion in assets and 84 trillion in transactions every year. That is what blockchain goes after and radically makes more secure and lower cost. It's a huge thing. The internet is good at communications and information and retrieval. Google, email, it's the best thing ever happened to the earth. But for financial assets, we need blockchain. And Bitcoin may or may not become the gold standard for digital assets. If it doesn't, Bitcoin's going to be useless. Bitcoin's only useful right now for money transfers. Has no chance of getting down to the everyday transaction level the way it's structured. There are coins that do.
I spoke with the Robinhood CEO a couple of days ago, and I asked him 2 or 3 times, hey, blockchain, let's go. Why aren't we using blockchain to settle securities transactions? The SEC is already running studies with Paxos on this. They expect to have those done at the end of the year. It almost seemed like he was dodging that a little bit. Do companies like Robinhood not want this blockchain to come? Is that going to take revenue away from their relations with like a Citadel or something? Or what's going on? And how do you know that blockchain is going to be the next big thing?
Okay. I was just talking to a friend that moved to Puerto Rico, Alex Lightman. He's a genius. He's got all these genius ideas. He can't understand when he throws out something as genius why people don't instantly get it. I understand. I've been throwing out the simplest new economic theory for 40 years now, and people still don't get it. When something's new, people don't adopt it until it's proven. When something's new, it's more expensive. Imagine blockchain is at 1%. Bitcoin is at 2% adoption in the US, 1% global, okay? It's a baby. Imagine when it's 50% or 90%, how much big it will, how it'll be stable then. It will be a fraction of the cost, automobiles, best thing ever, 1900, 1% of people, no, 0.1% had them. It took 14 years to get to 10%, and then another 14 years to get 90%, and only in cities. New technologies never move mainstream overnight. They're different. People have to restructure their systems for it. Blockchain's a different software, and it's more expensive than it will be in 5 or 10 years. So it's just doing what it's doing. But the point is, on the S curve, you always get a shakeout at this 1% level because 100 companies will enter, and then you got to knock it down to 40 or 50. By the way, .coms, 52% of the .coms in that bubble went under in the crash. 52%. Okay. Wow. And the first crash in autos, 100 companies went down to 40. So guess how many coins there are? Coins and tokens. 8,000, because ICOs are not regulated and don't cost as much. So tons of little companies, which is a good thing, a lot of innovation. Half of those will go under at a minimum. So that's good. You let a lot, the way innovation works, Kevin, and it's counterintuitive. You let the most things try, because a new technology, nobody knows what's the best solution. Nobody, ever in the early stages. You let a lot of things try, and then you keep shaking them out to the best, and then you get Apples and Microsofts and General Motors and Fords and stuff, and then they rule the world. That's how innovation works. This is the first shakeout, and it has to happen. We need.
So we could even see, much like we could see this Bitcoin bubble pop, and then a lot of these ICOs go away, and then we invest in Bitcoin. You might see the same thing happen. I think is what you're saying with electric vehicles. You kind of touched
absolutely, yeah. Okay. And that's a good thing. We don't need 50 electric vehicle companies, okay? And it's, what Elon Musk may be a little idealistic, but he has created a very compelling brand. He's Mr. Electric. People trust him. He's a genius, He's like the next important asset, okay? So that gives Tesla a huge advantage. But I'm telling you, you don't know. It was the second shakeout that General Motors finally passed Ford forever. Ford looked like they were going to dominate the industry right up until 1929, and they didn't end up dominating, but they came in number 2.
Okay. So
you have to let the markets, free market. The best thing that ever happened was this guy named Adam Smith says, guess what? The best
Free
way
hand.
to run an economy is the bottoms up, the invisible hand. Just set the rules, set the environment, and let innovation, let the spirit of God, you could even call it, in religion, flow. Don't block it. You know what central banks do? They block, worry, fear, Oh, we can't have recession. Oh, we got to tighten here. Oh, we got to loosen here. They're a bunch of ninnies.
So,
they shouldn't be running our economy. They're fighting free market capitalism and democracy, which started in the late 1700s, which have made us richer by 20 times than any time in history, and they're fighting that.
Right.
These people need to be fired. Fired
map
and
this
gone.
out then.
Central banks should only be emergency funding in a crisis so that the system doesn't melt down, but you should always allow the system to deleverage. You can give a little juice so it doesn't over deleverage, but in other words, I would have sanctioned that first $900 billion the Fed threw out in 2008, 2009. And then that's it. Once you give that enough liquidity so the banks just don't totally cave over, then you let the shakeout happen and see who survives. And that's the best solution. Not central bankers, not politicians. The best solution is what the markets end up developing out of.
How do we map this out then?
Bottoms up evolution.
Right. I'm trying to understand how to map this out. So right now the Fed is. Oh, can you still hear me? Did I lose you?
Lost you again.
No. Lost. Okay, no worries. You want to rejoin? Let's see here. Can you hear me now? All right, there we go. I sent you a quick little text. Maybe rejoin one more time. Yeah, that's all right. So we'll go ahead and pull. There we go. We'll wait for him to rejoin. So very interesting. I mean, it makes sense you couldn't hear me. I want to ask him now, how do we map this out? How do we go, like, what's next? Because the Fed has a course in front of us, right? The Fed has this plan laid out for us. And can you hear me?
Yeah, I'm back.
Yeah, okay, perfect. So my question is, how do we map this out? Because here's what I've got for now. I'm going to lay this out, kind of an opinion here, and I want to see you break this down a little bit. So currently, it seems like, at least what I'm thinking is the Fed's probably at minimum on any given day until we hear them start to taper bonds. We're probably at least 18 months away from any kind of interest rate increase, if we ever even see the interest rate increase. Honestly, I think they might keep kicking the can down the road. I don't see it coming anytime soon, and when it comes, I think it'll come slow. So, to me, I look at that and I go, okay, we don't have an interest rate risk. I personally don't think we're going to see a hyperinflation risk. So I agree with you on that. But the problem I have is I'm looking here, I'm going, okay, so if that's the case for the next, 3, 4, 5 years, where's this prick coming from? The needle that's pricking the bubble. I understand you say that the hedge funds are going to start deleveraging, but look, Ray Dalio's making bank right now. Why he doesn't want the party to stop yet? I know he's calling for this great leadership.
The hedge funds precisely, and the smart money precisely makes money by going ahead of investors. They're the 1% that start a new S curve, whether it's up or down. They're going to be first. Now, I'll just tell you, it's this common sense, Kevin. Look at the stock market in the last several years. Look at it particularly after the March bottom, after the COVID shock, 35, 40% crash. This thing has gone straight up like the economy is going to be better than ever. And we know today that at least 20% of the industries aren't coming back, small businesses, or aren't coming back for years. We don't get back, and we still have not employment. And none of this. The markets are on crack. It's because the Fed put $7 trillion, actually $4 trillion just in the last, less than the last year, and all this $4 or $5 trillion of stimulus. This is pure stimulus. When a market goes up, look at history and find a market ramp that fast, that short, that lasted even 6 more months, and you will not find it.
Wow. So you're saying
kills itself when it gets this extreme.
Even with, another 1.9 from a trillion from Biden and more money printing from the Fed, you're saying it's just not going to do anything at some point.
We already had the biggest combination of fiscal and monetary stimulus, even imaginable ever in history, and we're already got an economy that keeps coming in weaker. Oh, the employment numbers weren't that good. Oh, GDP. Right. Of course it's not that good. Consumers are spent out. They've given stimulus. They've refinanced their home 5 times now, bought a home with 8 bedrooms when they don't have any kids anymore. What the hell else are they going to do? There's a limit to what you can do with
Oh.
something for nothing. Something for nothing doesn't work.
Okay, so
Hard work,
I think I get it now.
Strategizing works.
What you're saying is the hedge funds are going to be ahead of this, but one of the things that might actually make this happen is the fact that people have so much money, they don't even know what to spend it on anymore.
What do you do? And where do I spend extra money? Vacations, Kevin. I can't take a vacation. I was supposed to do 2 tours. I lost a ton of money. 2 tours of Australia this year. Can't do that either. So my business took a hit. And in vacation, that's where I spend my extra money. My wife and I love to take, I mean, no frill. I mean, we don't put any cap when we go on vacation. You know what I mean? That's where we splurge. Can't do it. Nice. Where am I going to spend my money in COVID? Okay, am I going to eat caviar instead of steak? I don't even like caviar, you know?
I don't know who does. But let me ask you, I mean, this isn't going to last forever, this pandemic. I mean, we got vaccines coming. So why can't we keep going?
Well, okay. And this is an important point you just made. It is important. What I see is this chasm between now and when the vaccines actually are widespread enough, which I don't think is going to be till late summer, early fall at the earliest. Okay. And a lot of countries, Europe's way behind. Canada's way behind. We're actually doing better than some now after totally blowing it. That's a long period. From my point of view, Kevin, what I'm looking for, my best forecast, right on my, and look at my newsletter, my megaphone chart. This is a very clear chart. And it doesn't guarantee to happen, but megaphones are some of the best patterns because they only come at tops and people aren't used to them. The next crash should be 45%, as I said earlier. If the S&P 500, after all of this, crashes that much, which means we're also going into a deep recession again, I'm telling you, there's a point where people go, this doesn't work. And by the time people say that, Ray Dalio and the hedge funds are going to be way ahead of them. That's my forecast.
So you're thinking this is actually like, here I am thinking 2024, 5. That's way too far ahead to even be thinking about what the market might be doing then. I need to be thinking about the next few months is what you're saying.
The next 6 months is critical. 6 to 9 months is critical. If we don't have the crash by then and the vaccines do come, my second scenario would be, okay, we never have a big bubble burst. At some point, this has to deleverage. Stocks can't stay at 30, 40, 50 times earnings. Real estate can't stay at 10 and 11 times income. I mean, come on. It can't, because the next generation will never be able to afford it, and it's bad for the economy. But we won't have the big crash. We won't have the big deleveraging. We'll just have a slow mediocrity. Now, who does that sound like? Japan. Japan went down. You know, the only person on earth that predicted that damn downturn in 1989 when Japan looked like they could do no wrong and the U.S., Europe looked like we were going to be has-beens forever?
Right.
Me. Because I saw there's no brilliance, just saw their demographics, their baby boom came earlier, were peaking, and they had the biggest bubble in the world, a real estate bubble almost like China's today, a stock bubble like, 6-year bubble that was off bigger than our bubble until now. Just common sense.
Are we going to become a Europe before we become a Japan then? Because I mean, they've been struggling for a long time.
The difference between here's U.S., Europe, Japan, the 3 largest economies. That we are the strongest demographically. Our millennial takes us back to where the baby boomers were. That's not as good as the baby boomers, but it's better. Sure. Japan never comes back. Their demographics keep going down. Europe's keep going down. China peaked in 2011. Their demographics have peaked for decades. We are the best house in a bad neighborhood. All we need to do is deleverage, and we can lead the next boom for the developed countries while the emerging countries create most of the growth. That's what's the next boom going to be. So when we are looking at 2023, I'm going to be saying, okay, we had this crash. Yeah. Here's what you do. You can't buy everything that you had in the last boom. China's not going to lead. India and Southeast Asia will lead. And aging industries in developed countries will lead, not earlier stage, and on and on and on. It will be a different boom, but we will have a boom, and the U.S. will be the best country, other than Australia, in the developed world. Most developed countries are going to keep slowing down as far as the eye can see, because they're not having babies and they're not encouraging immigration anymore.
Wow. So you're recommending, it
God,
seems like
what is it
that.
with this
Oh,
shit?
did I lose you again? All right. He'll be right back. So, I mean, very interesting. I want to ask him then about specific recommendations now, in terms of, do we buy bonds? Do we buy treasury bonds? Do we pay off margin in our own personal debts? Oh, there we go.
Yeah,
We'll get. So,
I don't know what's cutting me off, but whatever.
oh, no worries. Hey, I thank you for coming back. So right now, then, do we start focusing on? All right, maybe I got to pay off some of these mortgages. Okay, I got lots of them mortgages. Do I
No.
start buying bonds now, or do I just keep
Okay.
keep playing the meme stocks and the game stops and printing some tendies and getting out at the right time if I can?
If you got a quick trigger and you're a damn good trader, yes. Most people cannot do that. The next crash will come harder. In fact, do you see how fast the last one was? 5 weeks, 35%, and globally 40%. Most people don't know how to play that. They will get out right at the bottom. They'll finally panic, and then it'll bounce up. But so that's not what I do. Bonds, high quality bonds have done well in the downturn and in the upturn. They've done pretty good. If we have this crash I'm talking about, they're going to do the best. So I'd be getting more into these 30-year treasury bonds, AAA corporates, that sort of stuff. If I am going to keep stocks, I get the more defensive ones and just get more and more defensive. And then if it starts to play out and you see that first sharp crash, that's a sign. Okay, on the next bounce, you get even out of more stuff, and you actually may want to actually short. The ideal portfolio for this downturn for somebody willing to take some risk is to be about 50% in high quality long-term bonds like the 30-year treasury, and about 50% unlevered, simply short, like PQQQ, the NASDAQ, or SH, the S&P 500. Not, because downturns are very volatile. Just sit in that, and the crash will work to your favor. Now, you can be really safe and sleep at night just having maybe some high quality bonds and a lot of cash. The cash will preserve your money, but it will not make money in a downturn.
Right.
In the 30s, only the high quality bonds made money. Stocks, real estate, commodities, normal bonds, and of course, junk bonds all went down.
Yeah, and so that's interesting because if there's going to be a lot of inflation, then bonds become next to worthless.
Oh,
But
yeah.
because you're thinking we're not going to see that high inflation, and potentially we're on this longer run cycle of lower interest rates, you have little risk being in bonds because as rates continue to trend down, the bonds that you bought today will become more expensive. And then if you have the crash, they'll become extremely more
Yeah.
expensive.
Now, again, though, people act like I'm telling them to buy 30-year treasury bond. No, when we see this bottom, let's say it's 2022 for stocks and 2023 for bonds and economy and real estate, that sort of stuff.
Okay.
The next boom is going to see mildly, but it's going to see rising inflation for a couple decades. Bonds don't do
Oh,
well in that environment. When I
okay.
say these high quality bonds, it's only in the crash. Once we see the crash bottom, let's say I'm kind of right and it's late 2022, early 2023, you're going to want to turn around and buy the best real estate and the best sectors and the best stocks, particularly in Southeast Asia and India. I'm telling you, India is going to be the next China. I've already done the math on their urbanization, their GDP per capita, another thing you can project reliably in the future. India is just way less urban than China, and China's overexpanded for that, and that's why they're going to be in so much trouble. India is going to be larger economy, larger population, and even higher GDP per capita down the road than China. India is the next China, and Southeast Asia is the other major region that's going to boom in the next boom. If you're in India, Southeast Asia, countries like Australia and the US, and particularly in aging industries and tech industries like blockchain and Bitcoin and Tesla electric vehicles, that's the way to play the next boom. But the key thing is make money or preserve your money so you have the money to play that boom. Most people will not have much money left in their accounts if this crash is half as bad
Sure.
as I say it's going to be.
Yeah, because I mean, you mentioned investing in Southeast Asia and India. I mean, forgive me, I've got a pretty solid home bias where I was just like, hey, give me my local real estate within 30 minutes and give me some stocks that I understand.
Well,
Like
yeah.
Tesla and
I
Apple.
got one for you, Kevin.
Okay.
Nursing homes and assisted living
Nurse.
facilities. It's the last thing the baby boomers do into age 84 peak. It will grow faster, and they'll never build enough nursing homes and assisted living. So you can invest in the U.S. in real estate, in nursing homes and assisted living facilities, or the companies that run them, or the company, or the people who provide them the real estate. and do very, very
Got it.
well.
So I could also then, to balance with stocks, I could also buy the Tesla and the Apple and let them
Yeah.
go invest in China
Well,
and
yeah,
Southeast Asia.
exactly. You can buy blockchain, Bitcoin, and Tesla here, and you don't need to be in Asia. I'm just saying,
Mm.
won't hurt to be an Asia fund, but you want a fund that's Asia, ex Japan and China, or ex. I mean, I'm telling you, East Asia, and people will not get this for a while, Kevin. East Asia has already peaked in urbanization and in demographics, and like Japan, there has beens in the future. So
So you're
the
talking
rest
about
of
between
Asia.
the Middle East and China, basically, like that West Asia, the Taiwans, maybe the
No,
India,
no, no, no.
Myanmar.
No,
Oh,
not Japan, not Taiwan, not South
okay.
Korea, and not China. China a little
Got it.
bit because they still have some organization. It is going to be all the Southeast Asia. That's Vietnam, Indonesia, Myanmar, Thailand, those sort of countries, and particularly India. I'm just telling you, India may be slow to start, but India is the next big thing because there's nowhere that can urbanize rapidly like China did and already has a strong urbanization curve that people aren't looking at. I'm looking at where India is today, 37% urbanization, and what their GDP per capita was compared when China was 37% urban just decades ago, and it's higher in India. India has the capacity to do better than China, and India has more English heritage and more entrepreneurialism. You got to remember, China and all of Asia is still a conformist culture, and conformist cultures are not at an advantage in the innovative entrepreneurial information age. India is not as entrepreneurial as the United States, but it's more entrepreneurial than East Asia.
Ah, I see. Okay, so I mean, the big signal that we're looking for soon is this. You mentioned 35 to 45% correction in the S&P, and that's
In a
over
matter
a
of
few.
months. That should only take
Okay,
2 to 3 months or so to happen. So
and,
if it
and then
starts
it's
in
going
late
further.
February, you ought to see it. We ought to be well into it right away. So if you even see a sharp crash in the next several weeks, that's a sign it's beginning. And by late June at the latest, I think even by April, you probably see the markets down 40% or more. That to me says this bubble is over. That's the final blow. I say you do not recover from a crash that big after so many crashes. In other words, we don't see a new high. And that would be the final proof. If we have that crash and we don't rush to a new high like we just did, we just rushed to a new high, okay? 35,
Right.
40% crash and right up to a new high. That I think will not happen.
So you're looking at us like Japan, like we're gonna have this high from 2021, and in the future, in 5 years, we're gonna be looking back. Oh, I lost that. Well, we'll have him go back. So he'll be right back. I mean, this is really interesting. So essentially, well, he'll be right back in a moment, and we'll catch up. Uh, Interesting. So next few weeks, really. All right, here we go.
Okay,
Harry, welcome back. All right. So what you're saying is we're going to be like Japan, where in 3-4 years we look back and we see this top of 2021, and we're looking back going, oh dang, are we ever going to go back to that? And we might not, is what you're saying.
That's right. If we do, it'll be at least 2036, 37, the top of a
Oh my
millennial
gosh.
boom. And and I'm looking at long-term history. I don't want to get too overwhelmed people here. I actually think because the millennials don't take us to new heights, the stock market and because we're coming out of the biggest bubble in history, we probably won't see stocks as high even 15 years from now as they are right now. We will have a great boom. If the Dow goes to 5,000, then maybe it goes back to 25 or 30,000, but you're not going to see it go to 50 or 100 in the next boom. It's not going to happen. The demographics are not there in the United States.
Wow.
And we have it way better than Europe and Japan and East Asia.
Yeah, what did Europe do wrong? I gotta ask you. You know what? Why is Europe struggling? I mean, I've heard austerity, and then we're gonna do stimulus instead of austerity, but that's not working. Like, what is Europe doing?
They got old. Do old people innovate or young people?
Okay.
How long has Europe been around? How long has Europe been wealthy? The U.S. is only 250 years old as a damn country. Okay, Europe's been around for thousands of years. Europe got old. Europe does not innovate. I used to give speeches in France. My first book, Great Boom Ahead, sold great in France and Switzerland for some damn reason. I'd give speeches over there. And after the first round, I said, I'm not coming back. I'm talking about innovation and new trends. They're like, oh, we don't like internet. Oh, we don't blah, 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 blah. Oh, no, we like to make our own wine. I'm like, well, screw you, you old, folks. You're not going to be in the new economy. They don't have the demographics. Older countries, wealthier countries, urban countries don't have as many kids. And what happened in East Asia is even weirder. They got rich overnight and their birth rates dropped even more. East Asia actually has collectively worse demographic trends in the next 20, 30 years than Europe does. North Europe has better than Southern Europe, but because they got rich and their birth rates just plummeted. They got rich. They're living in cities and condos. Who wants kids? Kids are in the way of prosperity and being the next great country and starting business and stuff. So demographics is the one thing that we can project in the future. And I can tell people any country in the world who's got rising demographics and falling. China and all of East Asia have falling demographics. Most of Europe, and except for Northern Europe, which is more like the U.S., that has sideways demographics, which is going to look damn good in the developed world. So the U.S., UK, France, and Scandinavia will lead the next boom in the developed world, and Australia, New Zealand. But in the developed world, I'm telling you, China is going to grow slower, still going to grow some, but much slower. And it is going to be Southeast Asia, India, and potentially the Middle East that leads the next global boom in emerging countries. And all the demographics are in the emerging countries. The developed countries collectively have peaked in demographics for as far as the eye can see. Nobody's looking at that fact. There's no way you can grow when your workforce is shrinking.
Got it. No, that makes sense. So, and you also think that the tokenization of at least digital assets will take over. Will that carry over to real assets? I mean, I'm hearing the tokenization of collectibles and art and real estate. What's your take on this?
Everything will be able to be easily traded, easily transferred, cross borders, low transaction costs, low transfer costs. Everybody's going to be able to see markets. I mean, just the fact, again, it was a great thing that the smaller traders on Reddit, were able to see for the first time what the hedge funds were doing and gang together and counter them. That's never happened before. That's a miracle. So this is going to tilt bottoms up finance, bottom money. My vision of the future without central banks, except as a backstop, is that money is only created out of the natural transactions to consumers, businesses, and governments. And there is a global standard, might be Bitcoin, might be something else, which everything's measured against. And not every country has their own currency and stuff. I think that's how much things are going to evolve. And think if the United States had 50 states with 50 different currencies, how big a mess we'd be in. And that was Europe not too long ago, by the way. This is progress.
So tell me, the future Wall Street bets, the GameStops, are they fragmented? Did they just get bankrupted and robbed of $19 trillion holding the bag? What's the future of this sort of collectivism from the retail investor? I mean, who's going to lead this? Is it just going to be a group of headless chickens now, or what's the future?
Well, they did show that they had, a lot of people made money on that, but you have to realize a lot of people had to buy to push GameStop up. Right. Now, people are on an S curve too. Not everybody bought at the same time. The smart people buy first. They're the ones going to make the most money. The more it goes up, people say, oh, this is working. So more people jump in. So the people, these everyday traders that jumped in at 300, 400, 500 got creamed when it went down. Now, last I heard, it was 60 or 70, and it's going to go back down to 10 or 20, I think. So they get creamed. But the people who bought in early, and then when it gets up to 400, 800, the smart money within the traders, remember, there's always smart money. They probably got out closer to the top and made a fortune. So in trading, especially with leverage, smart money always wins. The hedge funds have typically done way better than the everyday person. But even in the everyday people, now that they're getting more sophisticated and communicating more and watching the hedge funds, like the hedge funds used to watch us and plunder us, which they still do, but it's going to be harder. They may start doing better. So somebody called it the democratization of investing and finance. So we democratized politics a long time ago, and now it's special interests have taken over, and central banks have taken over the markets, which both things have to be rotted out here, have to be deleveraged as well. We need to get back to free market capitalism, democracy, with even more efficient, more bottoms up internet with blockchain and Bitcoin. It only makes the system faster, more efficient, more private, more secure, so that it can operate from the bottoms up. The more bottoms up, the more the everyday person does well. But there's always going to be people at the top that make more money. That's a law of nature.
Got it. Got it. And so you have a newsletter and you talk about this in your newsletter. What's in your newsletter?
Yeah. Okay. We have a weekly newsletter, Harry's Take. You can get on that for free at harrydent.com. People who sign up this week, I have the February paid issue, just had a whole issue on blockchain and Bitcoin. That will be sent to people who sign up for the free newsletter for free on March 1st. We have to wait a month. And then we have a paid newsletter, the HS Dent Forecast. The free newsletter, every week you're going to hear from me and my partner, Rodney Johnson, key topic stuff. We're not going to get as much into targets and, specific advice. That's people get comfortable with us. Then you get on our paid newsletter. And for what we give, it's very affordable. But I just tell people, get on the free newsletter. And if you like us, and we do the free newsletter because we know we're controversial. We know we're radical. I don't try to be radical. I have different indicators from economists, so I'm going to come to different conclusions. And our indicators do show turning points. Everybody else just goes with the boom until it busts. And when it busts, everybody sells at the bottom. Everybody has linear forecasting. We build cyclicality into our forecast. And I've got the best cycle system, large scale to small scale, I think, in history. So that's what we do in our newsletters. Tell you when things are going to turn in cycles, so you can be ahead of the game. And again, I've been predicting, Kevin, that the baby boom would peak in spending in 2007, 20 some years before it happened. And we go into a deep downturn. That's why we've had quantitative easing to offset that, which is bad policy, but that's what we've had. And I predicted back then the stock market would be at its lowest level in our lifetimes at the end of 2022. And I still have that forecast. And that will be the buy opportunity for all types of investments of our lifetime, just like late 1974 would have been, or late 1932 before.
And some of the indicators you're paying attention to, what are your top three? Is it the fact we've gone up? Is it demographics? Is it money printing? What are your top indicators?
Okay, we have the 90-year super bubble cycle. That's my number. That's the dominant cycle here. And we have our 40-year bottoming cycle. So this cycle's topping the super bubble, and the bottom cycle gives us a target for when it's likely to bottom, give or take. So that's the two most important indicators. We're looking at the smart money. The smart money has been, it may not look like it, but the smart money has been net selling into this top of this bubble, just like they did the top of the tech bubble. That's another important thing. So that's where we say, okay, we don't know exactly when it's peak, but when the smart money for months has been selling into this, and the other indicator we're watching, call options on small traders are going through the roof. We don't even have a comparison for this in past. That is a very bearish signal when the quote unquote, I hate to call it dumb money, is piling in with leverage. So those are some of the key indicators we're looking at now. And I look at chart patterns. Robert Prechter's a friend of mine. He's Elliott wave theorist. Chart things move in patterns, and this looks like the fifth wave of a fifth wave of a fifth wave to me, and it's in a blow off thing, and it's fitting I'll give you one more indicator this long term. People are going to laugh at this. The Masters and Johnson's male orgasm study, they charted out the male orgasm. It is a perfect bubble trajectory. I can put that on you can put me blindfolded, give me any market, even a birth trend, anything, and I can put that over it and tell you if it's a bubble or not, and if it's in the early or later stages. I can't tell you exactly when it's on top, but I can tell you that this bubble is definitely in what I call the orgasmic stage, the final blow off.
The last inning, so to say, as Ray Dalio says, huh? Wow.
Now, it might peak now. It might peak in June. I give it between, I think now the highest probability the next few weeks, and the next time would be May, June. If it lasts past that, then I'm going to be scratching my head.
Gotcha. Wow. How do people get in touch with you, Harry? Your letter or what's the best way to follow you?
Yeah. If you get on harrydent.com, then you get on our letter. We'll be talking to you every week. You're going to get this free, the best, I think, simple report. Bitcoin in blockchain is a very technical issue. And I'm hanging out in Puerto Rico with a bunch of blockchain techies because they're all moving to Puerto Rico for the tax advantages. So I get all the tech stuff. I try to make it simple and say, here's what's really happening at the macro level so you can understand this thing and know what it is. It is not an inflation hedge, and it's certainly not a safe haven. There could be nothing more dangerous than the biggest bubble in history, which is Bitcoin. It's only tulips were more radical than this. So they get that report, and then again, you'll know, and people will let you know. Oh, you want to get on our paid newsletter? Okay, here's our latest discount. So once you get on harrydent.com, we'll be talking to you.
That's amazing. And so you're actually living in Puerto Rico. Do you ever run into Peter Schiff and talk gold?
Yeah, I just debated him in an Australia thing a couple months ago. I'm going to do Jim Rickards in Australia. I do a lot of stuff in Australia, and yeah, we see him. He's 30 minutes from me in Dorado Country Club. I chose to be in the city. He chose to be in what I call Gringo Disneyland. It's really nice. I mean, it's a really nice country club. Puerto Rico has become a first world country. I've been going there for 26 years because I bought a big property on an island off of it way back, just because it's the best view I've ever seen in history. And I didn't move to Puerto Rico for a long time because it became first world because the pharmaceutical industry from the US. San Juan is the only first world city in the Caribbean. Now it has incredible tax advantages. The real estate is 50% or even more, less. My condo on the beach is a quarter of what it was in South Beach when we lived in Miami. So I'm extremely happy there. I didn't even move there for the tax advantage. I moved there to finish my house on the island and to get a condo on the beach for a quarter of the price. That's a big deal. Wow. So I love Puerto Rico.
You're probably suggesting living in California is a mistake, huh?
Well, if you want, I lived in California for 22 years. I only when I got an amicable divorce did I get out of there. I had 3 stepkids there. I could not leave. I paid so much state income taxes there. It was a crime. It was crazy.
Yeah.
I could have moved to Texas or Florida, bought a great house in California, spent 5 months a year there, and paid for the house with the tax savings.
Yeah, no kidding. Oh my gosh, just the tax arbitrage. And what do you pay, like 4% out there in Puerto Rico?
Yep. And then here was my biggest surprise. I get my property. I finally finished my house on the island. I get my property taxes. It's 0.1%. It would be 2% in Miami.
What?
So it was a 20th of what I would have paid in Miami on a similar car. I'm like, okay, I'm saving all these taxes. They got to kill me on the property taxes. No, the property taxes are even lower. I'm just like,
how do they make money?
Hmm?
How do they make money?
Sales tax is 11.5%. That's stupid because it hits the everyday person. I tell you, they're subsidized by the U.S. That the pharmaceutical industry pushed down there was a subsidy. Now Act 20, these tax breaks are a subsidy to get rich people down there and create jobs and buy real estate. It is subsidized by the United States, and it's got the worst demographics of any country in the world. They make Japan look like nothing. And it's not because of aging. It's because people are U.S. citizens and they can freely leave. Young people have been leaving for decades. Guess who's leaving now? The older people who go to retirement, look around and say, where's my grandchildren? Oh, they're in Orlando. Boom. They moved to Orlando. So the U.S., I hate to say it, is kind of stuck with subsidizing Puerto Rico. And it's to Puerto Rico's advantage. Otherwise, they'd be more than just a little bankrupt.
But that also creates this opportunity to save a whole ton of money in taxes.
Oh, my God. Well, again, I'm saving everywhere. Property taxes, income taxes, and living costs. I moved there on the saving and living cost alone. Volunteer and seeing over 20 years San Juan go from a so-so city to as nice as Miami from my point of view. The restaurant scene's about as good as Miami. And that's what I care about is restaurants.
That's beautiful. Oh my gosh. Yeah, I've been to Puerto Rico and San Juan twice, and it's absolutely unbelievable. Any final thoughts for the people watching right now? What do they got to do on Monday when they look at their portfolio and they're like, crap, I want to make a change? It's start researching those bonds, huh?
Yeah. Don't look a gift horse in the mouth. We've had the greatest bubble in history. This is a gift. Everybody has been enriched beyond what they deserve in lower interest rates, lower taxes, everything, and financial assets. Start pulling out. Don't look a gift towards mouth. Don't be an idiot and say, oh, well, I'll pull out at the time. Bubbles crash. They build exponentially. They crash twice as fast. A typical 5 to 6 year bubble will wipe out all those gains in 2 years. So don't think you can easily dodge this. And the guy, Baron Rothschild, the richest man in the 1800s in Europe, they asked, Baron, what is the secret to your wealth? And he says, I always got out a little bit early.
I think that's awesome. That's actually a great one to end it on.
Wake up. Do not think a bubble I don't care who tells you what. Economists don't know anything. They do not understand the economy. You see stocks go up straight up like this after we get a shock like this, and they print this much money at great. You know how much extra debt we just took on? $4 to $5 trillion. Okay. Wow. You cannot keep doing this. This thing will burst. And people will tell me the other thing I get, oh, Harry, okay, why can't these bubbles just kind of plateau? I say, if you can find me one bubble in anything that went up, tulips, real estate, stocks, anything in history went up at this trajectory and just hung up there, I'll kiss your ass in public because you will not find it.
I love it. Oh my gosh. Wow. You've given me a whole lot to think about.
Well, that's the point. You better think fast because I'm telling you, when this happens, it's going to be fast.
So diamond hands is a bad thing to say right now. holding is not what you're advocating. I got you.
No.
Get out of debt.
Now again, and I tell people, don't listen to your financial advisor at this one time. Most of the time when there's normal 20% corrections and stuff and recessions, yes, it's better to hold and rebalance. It's hard to time market. This is not the time. You do not sit through a once in a lifetime 80 and 90 year great reset. You do not sit there because 29 to 32 stocks went down, blue chips, not small caps, 89%, and took 24 years to get back to even in 1953. If you were retiring in 1929, you would have been dead before your stocks got back, and they wouldn't have got back because you'd have sold them when they were down, and you wouldn't have got back into them for many years, and you would have never gotten back to even. So you've got to wake up here. What I'm saying is proven by history. I know it sounds extreme, but I'm not extreme. The times are extreme. You can find me a stock bubble this extreme, then show it to me. You'll see a bubble that crashed right after if you find something this extreme.
Jeez.
This is extreme times, and you need to wake up to it. That's all. That's simple.
Wow. Harry Dent, thank you so much. HarryDent.com, right?
Okay, yes, HarryDent.com. Free newsletter and free Bitcoin bubble report.
Awesome. Thank you so much for your time. I really appreciate it. You gave me way more time than we talked about initially. So thank you for that. I really appreciate that. Hopefully the audience found it very helpful. For everyone watching, if you found it helpful, consider sharing the video. And folks, we'll see you in the next one.